Good afternoon. This is Robert Rayburn here at Life Pro Asset Management. It is July 17th of 2023. Glad that everyone was able to join us and hope that everyone had a great weekend. We got a lot to talk about. And in particular, we want to focus on the US dollar this week because over the last couple of months, we've really had a strong focus on what a lower US dollar would mean for asset allocation, what it would mean for commodities and inflation and all of those types of things. And so the title of this week's presentation is The US Dollar is Crashing, Now What? And really what we've seen over the past couple of weeks is that consolidation period that we saw with the US dollar in April and May and the first part of June is coming to a crashing end. And we've seen a big inflection lower for the US dollar, and we've seen gold inflect higher. We've seen oil start to bottom out, and we've actually seen a strong bottoming out of many commodities, both hard and soft commodities such as the grains, wheat, etc. All those things have really started to bottom out. And ironically enough, even though we got a very, very positive inflation report this week, in other words, inflation came in below expectations, it's those inflation trades that have actually started to perform. And you've seen it in our portfolios, and I think you've seen it across the broader marketplace where oil, copper, gold, all of those assets that generally speaking are leading indicators for a reflation trade have started to kick back into gear. So the three big things that we want to focus on this week: crashing US dollar, what does it mean for your money? That reported inflation keeps falling. Do we want to chase or do we sort of lean against it? So in other words, in the period leading up to this report, it was about deflation. Is the trade switching to reflation? We'll take a look at that. Lastly, the reflation factors such as energy and commodities are on the march, and obviously that's where we're positioned right now. But we'll speak a little bit more in terms of what that means. Now, what does dethroning the king? A few things here. The US dollar, in our opinion, is going through a bear cycle, okay? So that should be, we need to differentiate that from the US dollar is going to be replaced, right? There's just no viable candidates out there, whether it's the euro, the yen, the Chinese yuan. None of those currencies are well positioned to replace the US dollar. So that's not the thesis here. The thesis is that the US dollar is going into a bear cycle where interest rate expectations may start to peak out, where we start to see inflation expectations, generally speaking, peak out or stall at a certain level. In other words, the big advantage the US dollar has had over its peers over the last couple of years has been that we're tightening policy, raising interest rates much faster than everyone else. That concept is starting to go away, and you start to get this bear cycle that forms in the US dollar. And not just that, global growth recovering. So growth differentials are contracting between the US and the rest of the world. Again, that's US dollar, bearish US dollar, and that's positive for international equities, that's positive for commodities, and that's really where we think the next secular bull market is. It's in commodities, in our opinion. It's in the soft commodities, such as the grains, and international stocks, such as emerging markets, Europe and Japan. So that's where we think the strength is migrating to. Everyone is in technology right now. That's where the focus is, but we want to sort of take a step back and say, what's next? So the impact of that US dollar. You got to remember, as the US dollar goes down, the cost of imports into the US, and we are a trade deficit country, so in other words, we import more than we export. So the cost of those goods goes up. We requires more US dollars to buy overseas goods. That's a reflation check mark. Number two, commodities are priced in US dollars. So when the US dollar goes down, all things being equal, the price of oil, the price of copper, the price of natural gas, that stuff goes up. Again, barring everything else being equal. The fundamentals ultimately will sway the direction one way or the other, but the US dollar weakening or strengthening can exacerbate that direction, whether that's up or down. So if those two factors above play out, the market may start to very well begin to price in reflation despite the backward-looking inflation report that we got over the last week or so. And we've seen gold start to really benefit from that dollar decline. We had a bit of a minor breakdown in gold, what I would call a check back within a broader bull market from about just over $2,000 an ounce to 1,900. We've seen a strong uptick back to 1960. We look at the short-term trading conditions here in the chart on the top left. The daily percentage change, we saw a couple standard deviation upside moves. In other words, greater than 1.5% moves to the upside. Again, we're seeing volume come in. We're seeing urgency come in to buy gold stocks that have largely been unloved for the last couple of months. So we like where that is. We're obviously very overweight gold stocks here in the growth portfolios, and we remain so. And so, that's something we want to keep our eye on. Now, as it relates to the growth versus value trade, we're obviously much more toward value than we are toward growth. And so what we wanted to see is, as those potential interest rate expectations peak out, as those potential reflation expectations may start to perk back up, are we starting to see the very early signs of a growth of value rotation? And the answer is yes, a little bit, right? In other words, it hasn't been this huge tidal wave over, and we like that. If you've seen the portfolios over the last couple of weeks, we've had a very strong recovery, and that's really without a huge influx of money selling growth and buying value. We think that's stage number 2. So as technology continues to crack, as money rotates away from growth into value, we think that's the next inflection point in the value trade. We see that here in the blue line, growth relative to values beginning to peak out a little bit. Now we need follow through. This could very well be a check back within a broader growth bull market. We don't think so. We think these are the early stalling out signs of that trade. So, the other big factor is a steepening yield curve. If the yield curve starts to steepen, then we very well could start to see a rotation back into value. And we see that here with the 210 yield curve. We've had this dramatic flattening over the last couple of years. In fact, value had a little bit of life here in March as we got this big pop as it related to some of the banking crisis there. But that's what we call the wrong type of steepening, right? So if it's steepening related to a crisis, people are piling into treasuries, buying US dollars as a form of safety. Yield curve steepens in reaction to that. Why? Because everyone's bidding the 2-year yield down as it relates to expectations. The Fed's got a cut policy in order to respond to a crisis, versus this type of steepening where people are largely saying, hey, the economy is actually not quite as bad as people expect. So we do expect the 10-year yield to rise faster than the 2-year yield. We call that a bear steepener. So that when you see a bear steepening in that yield curve, that tends to be more a reflation trade than, say, a safety trade, and something we want to continue watching. Now, the heart of our presentation is, and this has been our thesis for the last couple of years, is that the technology super cycle is coming to an end and the commodity super cycle is in the first innings. And what we saw here is energy had this nice bounce off the bottom about a year ago. We've had a big check back in energy relative to technology. You see that right here. But what's the next step, right? So when we go back a chart or two here, we saw this was the initial stalling out. But now we're saying, is this an initial bounce, right? And that's something we want to pay attention to. So what does history tell us? So from 1998 to 2006, we had that big technology super cycle, a peak, and then energy started to bottom. But notice what happened. Energy had this big bottoming period, big rally, similar to this one here, and then checked back. And then people are like, oh, we're back into tech. But that was just merely a correction within the early phases of a commodity super cycle. And we saw then was a broadening out of the rally, and the rally would go on to new highs. We think we're at that same inflection point today. When we look at the fundamentals of oil and commodities, the fact that demand continues to outweigh supply, you've had huge supply constraints, not just in oil, but in copper as well. No real long-term investment in the space. We think the space is primed for a multi-year rally across the board. And this was oil in the 2000s, remember, rally, check back, and then this was the historic bull market that we saw in oil. 2001 was that initial test off the bottom, and then we went off to the races. Now, short term, we are starting to see that money is rotating out of tech and into energy. Does that mean tech stocks are going down? No, it just means they're going up less than energy. And what we see here is consumer discretionary relative to energy peaked out back in early to mid-June. And the same with technology. Actually, this really occurred in late May. Tech rallied, then we saw energy bounce back, and then energy has continued to rally at tech's expense over the last couple of weeks. And within the energy sector, we see that breadth continuing to improve. So the percentage of stocks above the 200-day moving average that we see here, the chart below, the prior peak was in March, 58%. That is now 62%. So as the energy sector has rallied, we've seen the rally broaden out. I think that's important to point out. And just as important is ETF flows remain dramatically subdued. So there isn't this huge rush into energy. That's good because we need that dry powder later on to push the sector onto new highs. So energy is improving while the flow of funds remains subdued. So the bottom line, ladies and gentlemen, is we believe we are in the early signs that the deflation trade may be long in the tooth, while the reflation trade might be on the rise again. So we want to pay attention to that. Three big things, takeaways for this week. The US dollar has resumed its crash. We want to, which does increase the cost of imports and inflation expectations in the future. The lower US dollar does tend to benefit commodities, which are priced in US dollars. And lastly, energy and gold are showing signs of leadership over the past couple of weeks. So that's what we got for you this week. Please reach out to your advisor if you have any questions whatsoever. 888-543-3776. Have a great week. And again, please feel free to reach out with any questions or concerns. Thank you again.